Welcome to a new episode of Inside the Economist Mind. Today we're diving deep into the April 2025 monthly economic report from T Corp, that's the Treasury Corporation for, well, in this case, New South Wales and Australia. They put together this really detailed analysis. Think of this as your shortcut, really, to understanding the significant shifts happening right now, in the global and Australian economies, especially considering some pretty impactful recent events. Our mission in this deep dive, well, it's to unpack these complex trends, explore how global policy changes are creating ripples, and ultimately understand what it all means for economic stability. And, of course, those potential adjustments to interest rates we're all keeping an eye on.
Absolutely. And this report, it gives a really insightful snapshot of a world navigating some unexpected policy decisions, let's say. What's fascinating here is the granular detail, how these decisions are actually translating into market reactions and economic forecast, both globally and right here in Australia.
Okay, let's unpack this, starting with the big picture. The global economic overview. April 2nd seems to have been a pretty pivotal date with President Trump's Liberation Day announcement. That was about increased tariffs on almost all U.S. trading partners. What was the immediate impact of that?
Well, the immediate reaction was quite pronounced. Financial markets saw a sharp increase in volatility, like a sudden jolt of uncertainty running through the whole system. And analysts pretty swiftly downgraded their expectations for U.S. economic growth.
Right.
Now, there was a partial recovery later on, as some of these tariff increases got delayed. But the report points out, quite astutely, I think, that the longer-lasting damage might be to confidence. Confidence in the U.S. as a dependable trading partner. And that kind of reliability, it's just crucial in international commerce. It takes time to rebuild.
Right. It's one thing to announce a policy, but quite another to assure everyone that the policy landscape won't just shift again without warning. And it sounds like the U.S. economy was already showing some, well, intriguing contradictions even before the full effect of the tariffs could really be felt.
That's a key observation, yeah. Data from the March quarter actually showed a resilient labor market, and consumer spending in the U.S. looked solid. But then you look at the surveys from April, and the picture darkens considerably.
Oh, so?
Well, consumer confidence just plummeted. It reached levels we last saw during the global financial crisis.
Wow.
Yeah. People suddenly expected much higher inflation and increased unemployment. And at the same time, U.S. businesses started scaling back their investment plans. What's really fascinating here is this divergence, between the recent past, the hard data, and what people and businesses expect for the near future.
Could there have been early signals in the March data, maybe? Things that weren't fully appreciated at the time, perhaps in those more forward-looking sub-indices?
It's possible. Hindsight is always 20/20, isn't it? But certainly the April surveys were a stark warning.
So we have this unusual situation. Recent data looks okay, reasonably robust, but the indicators of future activity are flashing warning signs, signaling a slowdown. What's the primary concern coming out of this?
The main worry is that this heightened policy uncertainty could trigger a significant change in behavior. It's classic economic theory, really. If consumers get more worried about their financial future, they're likely to, increase their savings and cut back on spending.
Okay.
And similarly, if businesses are hesitant about policy stability, they'll likely postpone those big investment decisions. And that combination, cautious consumers, hesitant businesses, it's a classic precursor to slower economic growth, potentially even a recession in the U.S.
And this creates a real headache for the U.S. Federal Reserve, doesn't it?
Oh, absolutely.
They're trying to balance managing inflation and supporting growth, and now they've got this added complexity, potential tariff-induced inflation alongside weakening growth prospects.
Precisely.
Yeah.
It puts them in a difficult bind. I mean, typically, weaker growth would argue for lower interest rates.
Right.
But if tariffs are pushing up the prices of goods, that really complicates the inflation picture significantly. So the Fed has understandably adopted a very cautious tone in its public statements. And you contrast this with, say, the European Central Bank. They actually implemented a 25 basis point interest rate cut in April, a basis point being 0.01%. And the financial markets are anticipating further cuts over there.
Interesting.
Yeah, this divergence really highlights how different central banks are reading and reacting to the current global economic landscape.
Okay, so that's the somewhat turbulent global picture. Let's bring it closer to home. How is all this international drama influencing the Australian economic landscape?
Well, the immediate impact seems to be on sentiment. Australian consumer sentiment took a notable 6% drop in April, which likely reflects that global financial market volatility, stemming from the U.S. trade policy announcement. However, the report suggests that the direct impact of these specific U.S. tariffs on the Australian economy itself? Well, it's expected to be less pronounced compared to many other economies.
Why is that? Any clues?
Perhaps because our trade relationship with the U.S. is structured differently than for some other nations, or maybe the specific goods targeted are less relevant to our direct trade flows. The report doesn't delve too deeply into the why, but notes the expectation of a lesser direct effect.
Okay, that offers some reassurance, at least on the direct front. And it sounds like the Australian inflation data provided some positive news.
Absolutely. The inflation figures for the March quarter were quite encouraging, actually.
Yeah.
Underlying inflation, that measure that strips out some volatile items to get a clearer trend, is running at a 2.5% annual rate over the past 6 months.
And that's right in the middle of the RBA's target band.
Yeah. Exactly. Right within the Reserve Bank of Australia's target. That's our central bank, of course. And what's particularly positive is that the slowdown in price growth was broad-based. It was especially evident in the private sector, which suggests that the fundamental inflationary pressures in the economy are genuinely easing.
Which I imagine has led the financial markets to be quite confident about what the Reserve Bank of Australia might do next.
That's right. The market is largely anticipating a 25 basis point interest rate cut at the RBA's policy meeting on May 20th. There's even a small possibility, apparently, of a larger 50 basis point cut being discussed, though 25 seems the base case.
And what about jobs? The unemployment rate?
Well, the Australian unemployment rate did edge up slightly to 4.1% in March, and overall employment growth has been a bit softer in 2025. But the report emphasizes there's no indication of a sudden, sharp economic downturn in Australia, nothing that would require a really dramatic response from the RBA.
Okay.
So a measured adjustment, like a 25-point cut, seems to be the prevailing expectation.
So a measured approach expected here in Australia. Now, let's delve into how all this uncertainty actually played out in the financial markets during April. It sounds like it was quite a ride.
Roller coaster is definitely an apt description, yeah. We saw extreme volatility across equities, bonds, currencies, pretty much everywhere immediately after Trump's tariff announcement. Equity markets had these sharp initial falls, but then they staged quite a recovery later in the month as some of those tariffs were temporarily eased or delayed. And you saw similar swings in the bond and currency markets.
And despite all that turbulence, the MSCI World ex-Australia equity market, that's the big global index minus Australia, it actually ended up with a slight gain. That's surprising, isn't it, given the big drops mid-month?
It is quite remarkable. It really highlights the speed and the size of that late-month rebound. But when you dig into individual markets, you get a more nuanced picture.
Okay.
The Australian share market, for instance, had a strong month. It gained 3.6%.
Why so strong here?
Well, it was partly fueled by the potential benefits for banks if interest rates are indeed lowered, as the market expects. Lower rates can sometimes help bank margins, or at least be perceived positively. In contrast, the U.S. S&P 500 index still finished the month down, minus 0.8%, even after recovering substantially from its lows.
In Europe.
European stock markets also generally lost ground, down about 1.2% overall.
And France seemed to have a particularly difficult time within Europe.
Yes, French stocks saw a significant decline, actually more than offsetting gains seen in Germany. Interestingly, though, emerging markets as a whole outperformed developed markets in April. Led by places like Mexico and Brazil, they were up about 1%.
Any reason for that outperformance?
It could be a few things. Perhaps these economies have different trade exposures to the U.S., or maybe investors were actively seeking alternative growth opportunities, amidst all the uncertainty in the big developed nations. Diversification, perhaps.
Makes sense. What about the bond markets? You mentioned investors expecting lower growth, potentially leading to lower inflation. How did that play out in yields? Remind us, lower yields often mean investors are seeking safety.
Generally, yes. Lower yields often reflect higher demand for the perceived safety of government bonds, pushing prices up and yields down. And globally, bond yields did tend to decline as investors anticipated weaker growth from these trade tensions would lead to disinflation that's slowing in price increases. However, the decrease in U.S. 10-year Treasury bond yields was actually pretty modest, only down 4 basis points.
Why only modest in the U.S.?
It likely reflects those ongoing concerns about the U.S. government's budget outlook, maybe some questions about continued foreign demand for U.S. debt, especially with trade tensions rising, and also those lingering worries about the inflationary impact of the tariffs themselves. It muddies the water.
So the U.S. bond market was a bit an outlier. Where do we see bigger drops in yields?
We saw much more substantial falls in places like Japan, down 17 basis points, and Germany, down a hefty 29 basis points.
Wow, Germany.
Yeah, there's even some discussion suggesting German government bonds, the Bunds, might be emerging as a new safe haven asset in this kind of environment.
Interesting. And closer to home, in Australia.
Australian government bond yields, both the 10-year and the 3-year, fell quite significantly, down 22 and 38 basis points respectively, which just reinforces those expectations we talked about for RBA interest rate cuts.
Right.
And T Corp's own bond yields mirrored this trend, declining across various maturities too.
And the currency markets. Also reflecting this uncertainty, I assume. Sounds like the U.S. dollar took a bit of a hit.
That's right. The policy uncertainty coming out of the U.S. did put some downward pressure on the U.S. dollar. The Australian dollar actually appreciated against the U.S. dollar, up 2.3%.
Okay.
However, it's important to note it depreciated against the euro, down 2.6%.
So a mixed bag for the Aussie dollar. Why the difference?
It could partly be those differing expectations around future interest rate moves. Stronger expectations of cuts in Australia versus perhaps fewer or slower cuts expected in the Eurozone might make the euro relatively more attractive. Plus, lower commodity prices also played a role, likely weighing on the Aussie dollar against some currencies.
Speaking of commodities, sounds like the broader worry about weaker global growth hit prices there too.
Yes, generally commodity prices declined in April. Iron ore saw a moderate fall, maybe cushioned a bit by hopes of policy stimulus in China that could boost demand for raw materials.
But oil?
Oil prices experienced a very sharp decline, down 15.5%. That likely reflects those increased concerns about the prospects for global economic growth quite directly. Less growth usually means less demand for oil.
Okay. Finally, let's just touch on what T Corp themselves are forecasting. What are their expectations for interest rates and bond yields looking ahead based on all this?
Well, T Corp's forecasts indicate a gradual decrease in the RBA official cash rate through to December 2026. We see a similar downward trend anticipated for the 90-day bank bill rates, those short-term bank borrowing rates, and for the 10-year Commonwealth Government Securities Bond yield, the longer-term Aussie government debt return. They're predicting a gradual decline through 2025 before it sort of stabilizes in 2026.
So that aligns pretty well with the market view.
Yes, it generally aligns with those broader market expectations of a loosening of monetary policy here in Australia, largely in response to that global uncertainty and the low domestic inflation we discussed earlier.
Okay, so let's try and wrap this up. It really seems like President Trump's trade policy announcement created a major ripple effect globally. Lots of market volatility, a real dent in confidence, particularly in the U.S.
Definitely.
But while the Australian economy felt some of that, mostly in consumer sentiment, it seems, it appears relatively resilient overall, especially with those positive inflation figures bolstering expectations of RBA rate cuts. So we're observing this real contrast, aren't we, between the U.S. sort of grappling with policy uncertainty and its impact on confidence, and Australia, where low inflation seems to be giving the central bank more flexibility.
That's a very succinct summary. I think what's really striking here is how a policy decision in just one major economy can have such immediate widespread consequences across global markets, significantly influencing the economic outlook for almost everyone else.
Yeah.
It just really underscores the interconnectedness of the modern global economy. You can't easily isolate these things.
No, really can't. So what does this all mean for you, the listener? I mean, considering this intricate web of global economic forces and policy decisions, how might these seemingly huge, large-scale events have unforeseen, maybe long-lasting consequences on your own financial well-being, your investment strategies? It certainly prompts a deeper reflection, doesn't it, on the critical role that international trade and, frankly, geopolitical stability play in even our most personal economic outlooks. It's definitely something to keep in mind as you navigate your own financial decisions in these, well, uncertain times.